Hi, this is Tony Capreos from Axion Financial Group. Thanks so much for joining us today. In today's video, we're going to discuss the recent interest rate hikes by the Fed and a few impacts for an individual investor's portfolio. Stay tuned and thanks so much for joining us today. Last week, the Federal Reserve increased the federal interest rates by 75 basis points. 75 basis points is the highest interest rate hike since 1994 by the Fed. And the fact that last week they increased the interest rates by 75 basis points and also did the same thing a few months ago, it's the highest back-to-back magnitude interest rate hike by the Fed ever in its history. Now, how does rising interest rates impact an individual investor's finances and investment portfolio? Here's a few ways that it does impact. One, it makes mortgage rates that much higher for new home buyers. Interest rates for mortgages are now hovering around 6%. Just 12 months ago, interest rates for homes, for mortgages, were hovering around 3%. So within 12 months, the mortgage rates almost doubled. That makes monthly costs for mortgages significantly higher, which will unfortunately impact the type of home that many people can afford. Another way that rising interest rates impacts individuals' finances is home equity loans, interest rates increase, credit card interest rates increase. Also for investors, treasury bills, bonds, other fixed income instruments, those interest rates increase, which for investors is a good thing because you can now get a little bit more yield on your money in those instruments. So these are just a few ways in which the Federal Reserve's interest rate rises impact an individual investor and consumer's situation. Now, just as an aside, we invest in some fixed income alternatives that also are actually pretty good in rising interest rate environments because they invest in what are known as floating notes or floating interest rate notes. And what this allows that fund to do is, instead of being locked into a particular interest rate and then over the period have interest rates potentially rise, it allows them to adjust their interest rates that they charge for their loans as interest rates rise. So in this environment where interest rates are rising at a significant pace, it allows the interest collected on those loans to rise as interest rates rise, so it doesn't have a negative impact on the fact that interest rates are rising. Now, if you invest in, let's say, longer term maturity bonds, as interest rates rise, the yield goes up, but the actual face value of the bond declines. So the goal in terms of fixed income alternatives is looking for things that can actually do well in a rising interest rate environment that isn't negatively impacted by rising interest rates, because a lot of traditional fixed income can be negatively impacted as interest rates rise. And as we talked about in the beginning of this video, with interest rates rising substantially is an important aspect when you're looking at fixed income or fixed income alternatives. Anyway, I just want to thank you for joining us today for this video, and please stay tuned for the next video. Take care.